In this video, I will discuss risk matrix model, a model to measure market risk exposure for a financial institution. The ultimate objective of market risk measurement models can be best described from a quote by Sir Dennis Weatherstone, the former chairman of JP Morgan and Company, and now JP Morgan Chase. So once he stated that at close of business each day, tell me what the market risks are across all businesses and locations. So, in short, the chairman of JP Morgan wanted a single dollar number at the end of each day that would tell him the bank's market risk exposure the next day, especially if the day turns out to be a bad day. Okay, so when we measure market risk here, we will essentially find out a dollar amount of the risk a financial institution is exposed to, the trading portfolio would be exposed to if a day turns out to be bad day. That means, let's say that day will be a bad with regard to the worst 5% case. Okay, so market risk is estimated as estimated potential losses under adverse circumstances. So how much the loss you can incur if, as I said, the day turns out to be a bad day. So we calculate daily earnings at risk, which is dollar market value of the position multiplied by price volatility. So dollar market value of position is simple, like what's the value of the portfolio in a day. Price volatility is essentially the multiplication of two components. One is price sensitivity of the position, another is the potential adverse move in yield. Okay, we will see how we find out price volatility shortly. Now, risk matrix models calculates daily earnings at risk for different component of a portfolio. So here we are considering a portfolio that includes fixed income securities, foreign exchange, as well as equities. So what we will be doing is we will be calculating this daily earnings at risk, or the earnings at risk for each of these components, for fixed income, for foreign exchange, and for equity. Then we will aggregate them to find out the total market risk for the financial institution. So first of all is a daily price volatility. You can remember this component, the price volatility. So daily price volatility is the modified duration. You can remember we learned in previous weeks how do we calculate modified duration. So modified duration multiplied by adverse daily yield move. And we also know that modified duration is duration divided by 1 plus R. R is the interest rate. Now, to find out market risk of each of the component of this portfolio, we need to derive a confidence interval. Okay, it's a statistical measure. So I will remind you simply what do we mean by this confidence interval and how do we derive that. If you can remember, a basic about the normal distribution is the 68% of a data series. If it's a normally distributed, 68% of the observation will lie between plus minus 1 standard deviation. Okay, for example, if it is a mean value, let's say mean value is 10 and standard deviation is, let's say, 5. So if we add this 10 and 5, we get 15. And if we deduct 5 minus from 10, we get 5. So if a distribution is normally distributed with a mean of 10 and a standard deviation of 5, then 68% of the observation will lie between this range, plus minus 1 standard deviation. That means 5 and 15. 98% of the observation will lie between plus minus 2 standard deviation. So here it's 5 is the standard deviation. 2 standard deviation means 10. Okay, so 10 is the mean value and 2 standard deviation is 10. It will be 20. And if we deduct 10 minus 10, it will be 0. It means that 95% of the observation will lie between 0 and 20. And 99.7% of the observation will lie between plus minus 3 standard deviation. So if you are worried about this characteristic of normal distribution, then Let's go for a more concrete example. Suppose we define bad yield changes such that there is only 1% chance that the yield change will exceed this amount in either direction. Since we are concerned only with bad outcomes and we are long in bonds, for example, there is only 1% chance, that means 100 basis point chance that the next day yield will increase, which exits this given adverse move. Okay, now if we assume that yield change are normally distributed, then we can fit a normal distribution of the histogram of recent past changes in 7-year zero coupon interest rate to get an estimate of the size of the adverse rate move. Okay, so from the statistics that we have just seen in the previous slide, we know that 98% of the area under the normal distribution is to be found within 2.33 standard deviation. Okay, so what I said a few moments back, you can remember that 95% of the observation will lie between plus minus 2 standard deviation. Am I right? Now, if 95% chance that it will lie between plus minus 2 standard deviation, there is 98% chance, 98% of the observation will lie between 2.33 standard deviation. Okay. So if we multiply standard deviation or the sigma by 2.33, that means 2.33 sigma, it means that the adverse change will lie outside this range with a possibility of 2%, because 98% of the observation will lie between this 2.33 standard deviation. Are you with me? So for example, if we come here, let's say that the 7 years rates has a 0 mean and 10 standard deviation. Okay, 10 standard deviation. So there is a 2% chance that the yield change will be exceeding this 2.33 standard deviation, exceeding this 2.33 standard deviation. Now, since we are only considering about the worst outcome, not the upside potential, so if 98% chance that yield will be higher than these, and I'm sorry, if there is 2% chance that yield will be higher or lower than this 2.33 sigma, it means that there is 1% chance that it will be higher than this, and there is 1% chance that it will be lower than this. Am I right? So we are only considering this part, higher than this, because if, you know, if interest rate goes up, the value of the portfolio will go down. So there is 1% chance that the rate will exceed, the 7 years bond rate will exceed this. And if it's 0 mean and 10 was the standard deviation, 10 basis point was the standard deviation, so it will be 23.3 basis point. Am I right? So this, there is a 1% chance that the change will be higher than this 23.3 basis point. So let's come back to our example. Suppose that during the last year, the mean change in the yield on 7-year zero coupon bond was 0%, that I just mentioned, while the standard deviation was 10 basis point. So 2.33 sigma, 2.33 sigma or 23.3 basis point is the chance that its yield will be greater than this. Now, in other words, over the last day, daily yields on 7-year zero coupon bonds have fluctuated either positively or negatively by more than 23.3 basis point 2% of the time. Okay. Adverse moves in yields are those that decrease the value of the security. These occurred 1% of the time, or 1 in 100 days. Okay. So what we are actually arguing that since the 98% of the rate changes will be between these, so 1% chance that rate change will be greater than this 23.3 basis point, I mean the higher than 23.3 basis point, and 1% chance that the rate change will be lower than 23.3 basis point. Okay, so given this information, what can we now do is, so this is, you can see, assume potential movement is 1% chance, and assume normality that I have discussed so far. Standard deviation is 10 basis point and mean is 0 basis point. So you can see that it will be higher than 23.3 standard deviation. So the potential adverse movement will be 23.3 basis point. Now, how do we calculate price volatility then? You can remember the formula for price volatility is modified duration into adverse daily move. So this is how we calculate modified duration. We already know how do we calculate modified duration. The maturity divided by 1 plus interest rate multiplied by the potential movement. Okay, as I said, that there is 1% chance that the change will be this 23.3 basis points. So modified duration multiplied by this movement. So our price volatility is 1.5 to 1. Okay. So this, if price volatility, you can see, is modified duration multiplied by potential adverse change in yield is minus 1.521%. Okay, so since it is minus 1.521%, what does it mean? It means that for 1% change in the interest rate, the risk is the value of the portfolio will decline by 1.5 to 1%. So what's the earning at risk? So earning at risk, you can see daily earning at risk is market value of the position. The financial institution has investment of $1 million in the bond portfolio, multiplied by the price volatility we just recalculated. So it's 15,210. It means that if 1% yield changes, if yield changes by 1%, at first yield changes, then the value of the trading portfolio will decline by 15,210. The value of the portfolio will decline by this amount. Now, this is the case, okay, that 15,210 is the potential loss of the portfolio given that the price changes, the interest rate changes in excess of what expected in the 98% cases. Okay, now this is for the daily earning at risk. Now, if we want to calculate it for, let's say, weekly, monthly or so, then we can use this formula, dr into the square root of n. So dr is the daily earning at risk multiplied by the square root of days. Let's say we want to calculate it for 5-day period. So it's a daily earning at risk 15,210 multiplied by square root of 5. So the value at risk is 34,011. Okay, it means that there is 1% chance that the value of the portfolio can decline by $34,011 in a 5-day period. Okay, in the worst case scenario, there it's in the 1% cases. Now, that's the tier for the fixed income security. Now, as I said, that portfolio also has a component of foreign currency. So we calculate DR in the same manner for the foreign currency portfolio as well. So we have foreign exchange position, which is the value of the investment in the foreign currency in terms of Australian dollar, then per unit of foreign currency. So we have dollar value position multiplied by price volatility. Okay, this is the same formula, dollar value position multiplied by price volatility. And last of all, for the equity portfolio, now you know that as far as the equity is concerned, there are the two types of risk: systematic risk and unsystematic risk. And just a reminder that systematic risk reflects the co-movement of the stock with the market portfolio, which is measured by stock's beta. And the volatility of the market portfolio is typically denoted as sigma M. So unsystematic risk is, on the other hand, is related to the firm itself. In a very well diversified portfolio, unsystematic risk can be largely diversified away and leaving behind systematic risk or the market risk. So if the financial institution's trading portfolio follows or replicates the return of a stock market index, then beta of this portfolio will be 1, because the beta of a market portfolio is also 1, since the movement of the return of the financial institution's portfolio will be 1 to 1 with the market. Okay, and the standard deviation of the portfolio will be sigma, will be equal to the standard deviation of the stock market index. Okay, so to calculate DR for equity portfolio, we first calculate the dollar value of the position and then stock market return volatility. Okay, now why we are talking stock market return volatility instead of the volatility of the portfolio? We are assuming that the portfolio is a well diversified portfolio, and that's why the volatility of the portfolio will be similar to the volatility of the market portfolio. And the volatility of the market portfolio will be 2.33, which is, you can remember, the 2.33 standard deviation that captures 98% of the observation multiplied by the sigma standard deviation, which is the volatility of the market. Okay. However, you need to remember that if a portfolio is a less diversified portfolio, then DR should have another component which should reflect unsystematic risk. Now we have all the three components. We have calculated DR in the same manner for the zero coupon bond, for the foreign exchange position, and for Australian equities. I mean, for the equity portfolio. Now, if we want to calculate daily earning at risk for the entire portfolio, I mean, for the bonds, the foreign exchange, and equities, keep it in mind that we cannot simply sum them up. We cannot simply sum 15,000, 13,000, 466,000 to find out the total risk of the portfolio. Okay, the reason is, that these different components are correlated. When we put them in a portfolio, there will be some offsetting factors. Okay, for example, exchange rate and equities can be negatively correlated, or the bond and equities can be positively related, however, less than perfectly positively related. That's the reason the earnings at risk will typically be less than what is the sum of these three. Okay, so this is how we find out the aggregate the earning at risk. This is the formula. You may be familiar with this formula. So this will be the DR of the portfolio. So DR of the component 1, DR of component 2, DR of component 3 squared. Then the 2 into correlation between A and B, DR of A and DR of B, 2 into correlation between A and C, DR of A multiplied by DR of C, and 2 into correlation between the B and C, and then DR of B and DR of C, and then whole square root. Okay, so if we just use this formula for these three and find out, we will see that it's not just the sum of all these three. It will be less than sum of these three. Okay, so this is how we actually calculate the DR of an aggregated portfolio. So this is an example for 3 asset case. However, we can extend the formula for multiple assets. There are 2 weaknesses for this risk matrix model as well. First of all, you can remember that all this calculation is based on an assumption that the returns are normally distributed. However, there are some security returns, those are not normally distributed. For example, particularly options or short-term securities, for example, bonds. And another point is, you also have noticed that the calculation of this market risk under this risk matrix model is also not very simple. It's sort of tedious and complicated because we need to calculate standard deviation, correlation matrix, then we need to aggregate them for the entire portfolio. So it's also a bit of complicated. So this is the end of our discussion about the risk matrix model. In the next video, we will be discussing the other models of measuring market risk. Thank you very much.